Okay, I think we're ready to get started. Thanks everyone for joining today. My name is Jake Saba with Apex Capital. We partnered with QuantStreet, Harry and Isaac, to help them with distribution and marketing to primarily the RAs, the Registered Investment Advisor Network. There are 6 of us, and we meet with RAs throughout the country, introduce them to products and services, and QuantStreet is our OCIO partner, and they'll get into what they do, but we're very excited to be working with them in helping advisors free up their time, right? Like Harry will talk about how he does what he does, but the way I explain it is that QuantStreet handles the asset allocation, the investments for the registered investment advisors, so they can have more time to meet with clients, go raise more assets, and run their business. So there's a lot to what Harry and Isaac do. You're going to find out some of that today. Today, they're going to go over an update of the markets, talk about inflation and valuations, very timely information. And this is part of what they do, educate the investors and the advisors on the markets, why they're allocated to where they're allocated. And just a little snippet too, and Harry will get into this, that they use some state-of-the-art machine learning and other technologies, other factors to determine how they allocate. So, if some people are creating models that are just by Morningstar stars or people they know, Harry and Isaac have come up with a methodology to instill confidence in the allocations for the clients. They'll even do projections and other pieces of technology to show where investors might expect their money to grow over periods of time. But I don't want to steal too much thunder. Just wanted to make the introduction and explain the partnership. So I will hand it off to, I think, Isaac, sometimes you do the prelude to Harry's presentation. So thanks everyone for joining. Isaac, I'll hand it off to you.
All right, Jake, thank you so much. I very much appreciate the introduction. So my role in this process is I'm just going to give a very brief introduction of Harry and a brief introduction of myself, and then Harry will jump right into our substance. So by way of brief introduction, Harry is our Chief Investment Officer. He's a professor at Columbia Business School, where he is the faculty director of Columbia's program for financial studies. He's also, by the way, my older brother. I think that's probably his most notable characteristic. But Harry has over 20 years of experience in finance practice and academia. Prior to his role at Columbia, he spent many years as a portfolio manager at major banks and hedge funds. And what makes us different from many other portfolio managers is that our strategy is based on rigorous academic research combined with Harry's industry experience, and it gives us a sort of unique approach to asset management. As for myself, by background, I am a corporate lawyer, and at QuantStreet, I had our operations and compliance matters, and I am also here to introduce these presentations. So with that, I will pass it over to Harry, and thank you all for being here very much.
Okay, great. Thanks, Isaac. All right, I forgot to advance the page. I already messed up once, but this is a brief overview of QuantStreet. But Isaac just told you guys about it, so I'm going to move past this. So thank you all for being here. I see we have a nice group of people who are listening to us. I know some of the names, and also it's nice to see a lot of names I do not know, which means our message is getting out there. So I'm going to talk about 4 general bullet points, really 3. One is I'm going to introduce this idea of there is no alternative. What is that about? We'll talk about it in a second. Then we'll talk about inflation, which is, on everyone's mind nowadays. And then we'll talk about valuations and how we think about actually positioning the portfolio. And then hopefully the benefits of investing with QuantStreet will become so self-apparent that we won't even need to do that one, but we'll just for the sake of completeness, talk about it a little bit as well. So here's a headline, if you've been following the Wall Street Journal. Actually, when I first read it in the morning a few days ago, I didn't really know what it meant, but it said that Wall Street concedes there is finally an alternative to stocks. And then it talks about Terra and Tapas and Tiara, which I didn't know what those are battling to replace Tina meaning there is no alternative, as traders' favorite investing mantra. So, okay, I had to look up what these things are, but here's what they mean. So Tina means there's no alternative to stocks. And so this is sort of the prevailing thing that was going on in markets for many, many years, after the global financial crisis. So we all, or many of us, remember that. I remember when it all began, I was working at Citigroup, and which was one of the deeply affected banks. And, it was a really tumultuous time. And when that happened, the Fed engaged in a lot of monetary policy easing, most famously in quantitative easing and other forms of policy accommodation. And they brought interest rates to a very, very low level where interest rates stayed for many years. And with interest rates being so low, this sort of idea evolved that really there is no alternative to investing in the stock market because there's just no yield in any other asset class. And now this gives way to the next set of acronyms. So TARA means there are reasonable alternatives. TAPAS means there are plenty of alternatives. And finally, TIARA means there is a realistic alternative. So the point being that all of a sudden, or not all of a sudden, but recently there is alternatives for folks. Rather than only investing in stocks, you can go and invest in these other asset classes. So let's just kind of trace the evolution of markets over the last quarter. So over the last 3 months to kind of see how we got here. So this chart is showing you two plots. The white line is just the S&P index. Hopefully you can see this little red laser pointer. And the blue line is a level of 10-year treasury yield. So this is the US government sort of benchmark bond. And the yield is the rate of return you would hold from owning that bond if you held it to maturity. And what happened was at the turn of the year, so in January, we had a big rally in financial markets, which manifested itself really in two ways. One was stocks went up, so that's the white line. And the other one, alongside stocks, interest rates fell. And so this was a very good month for QuantStreet and for financial markets more broadly. And then when February came around, suddenly you had a reversal of a lot of these trends. Stocks began to sell off. Interest rates began to go up precipitously. So that's this large increase in the blue line. And a lot of the narrative in the market changed a lot. And what happened was that early on in February, there was a great jobs report. So every month there is jobs data that comes out. And the one that came out in early February was a really stunningly good number, which made the economy look like it was growing much faster than people had thought, and which then introduced into the market a lot of fears about inflation. And as a follow-on to the fear of inflation, what will the Federal Reserve, which is of course the US central bank, do in response to these inflationary concerns? And as the month went on, we had more and more data points coming in that were showing that, the economy is growing really well. We're creating a lot of jobs, and maybe some of the inflationary pressures that people had thought were sort of in the rear view mirror are not quite as in the rear view mirror as the hope had been. And so that brings us to basically right now where we are in markets. And now we have to, figure out like, okay, what do we do with all of this? And, one of the things that has happened, of course, is that even over the course of this 3-month period, interest rates went up, which means investing in bonds now looks more attractive because you get higher yields. And stocks went down, but maybe we'll argue stocks haven't gone down quite as much as they should have, given the large move in interest rates, which might at the margin make fixed income investments, bonds, a little bit more attractive than stocks when you're thinking about portfolio allocation, which we'll talk about. So go to yesterday. So the big event yesterday in financial markets was that Jerome Powell, who's the chairman of the Federal Reserve, was giving testimony to the Senate Banking Committee. And there's a picture of him giving testimony from the Wall Street Journal. And I must say, I talk a lot, I teach classes, I present at conferences. I've never had, that many reporters staring me in the face, trying to take my picture as I'm giving a presentation. It must be a little bit daunting, but he seems unfazed by it. And lo and behold, when he was talking, I don't know if you guys were following the market yesterday, but right here, this big jump down in the S&P happened right as Powell began his testimony to the banking committee, which started at 10 a.m. So clearly the market is very focused on what Jay Powell says, what the Federal Reserve is thinking. And whatever he said, the market didn't like it that much. And what he said actually was feeding into that picture I showed you before of the inflationary concerns having, woken up again in the month of February. So here is some text from the article. So they mentioned the jobs report. They said that 517,000 jobs were created in January. That number came out in early February, and it was a shockingly high figure, which was much higher than the expected amount of job creation. And it concerned the Fed. And what really concerned them was that this increase in jobs, a stronger job market than they had anticipated, might cause inflation. And then the article goes on to say that the recent strong economic data, including this jobs report and other data points, shifted investors' expectations about interest rates. And those expectations rose again during the hearing, because what Jay Powell said was basically, we may have to raise rates a little bit more than we were thinking a few weeks ago. And by the end of his testimony, investors anticipated Fed funds rate would rise to between 5.5% and 5.75%. So they sort of are revising upward their beliefs about Fed monetary policy. Okay, so that's sort of the backdrop. Now, what is the mechanism here that takes these concerns about inflation, the concerns about fast economic growth, and translates them into market turbulence? So here is the chain of events that I think is taking place in the minds of market participants. Higher inflation, as measured by the series that I'll show you some of these pictures in a few minutes, higher inflation, and as importantly, higher inflation expectations by consumers. So those two things together cause the Fed to raise interest rates. And if not to raise interest rates, they signal that they intend to raise interest rates. And by increasing interest rates, if stock prices don't sell off, it means stock prices look a little bit less attractive than they did when rates were lower, because you now have this better alternative. So what happens in the market is that stocks and bonds end up both falling in price. Okay, what's the effect of that? Well, when stocks fall in price and bonds fall in price, the cost of capital for firms goes up. The cost of borrowing for consumers increases. And so companies and consumers now have a harder time raising capital, borrowing money to invest, to spend, and that slows the economy. And that causes inflationary pressures to subside. So when you're thinking about what is in the Fed's mind, they're seeing inflation and they want to get to this economic growth slowdown, because when that happens, inflation pressures will subside. And they have this dual mandate of ensuring employment and controlling the price level, controlling inflation. And a key mechanism for them to accomplish this is really through the financial markets channel, which is, I think the Fed, all things being equal, would like to see stock prices a little bit lower, because that's going to contribute to the slowdown that's going on in markets. I don't think they want to see a stock market crash, but they certainly want tighter financial conditions. And this part here is one of the key ingredients for how the Fed can achieve tighter financial conditions from where we are to where it would like to be, which is that 2% inflation target, which the Fed has communicated to the market. So this just sets a backdrop of this idea of there is no alternative, which is the prevailing, investor mantra for many years post the global financial crisis, to where we are now, where rates are higher, stocks have sold off a little bit, maybe not quite as much as they could have, and the Fed is trying to slow economic growth to control inflation, get it to that 2% target. So the key thing, if you are, reading the market's tea leaves, is to think about, your own assessment of inflationary pressures. Of course, the Fed has a staff of economists, both at the board in Washington and across the country in the regional Federal Reserve banks. And, I know many, and some are, I've worked with many of them. And they're really great economists, and so their views are really strong and intelligently formed views. But let's let's just look at some of the data underlying inflation, the inflation narrative, and think for ourselves, what are things looking like, and why so much trepidation on the part of investors and the Fed. So, the market is very focused on inflation, obviously, and there are two major inflation measures, actually more than just two, but there are two major ones in the US. One is called the Consumer Price Index, or the CPI, and one is called the Personal Consumption Expenditure Index. And the way these are different is the CPI largely looks at consumers, and the PCE index looks more at firms. And as a fraction of the index, housing represents about 1/3 of the price of the sort of goods and services inside the CPI index, and only about, 1/6 or so of the PC index. So housing plays a much bigger role in the CPI. And if you look at a picture of the evolution of these series over the last few years, you see very clearly what happened, which is after the COVID-19 crisis. So right here, when COVID began, that was sort of deflationary. But when the economy began to sort of reawaken from that COVID slumber, we saw a real large increase in inflation, both in the CPI inflation, the blue line, and then this brownish line is the PCE. And then they sort of topped out about by early 2022, and that's when the Fed actually began this tightening cycle. And of course, that was the big story of 2022. And actually, it worked. When you look at what happened to inflation, it started to tick back down in the US. Both the CPI measure and the PCE measure started to go down, which is exactly what the Fed wants to see. And the concern that they're having now isn't really about the general trend. I think they're comfortable with the trend. It's why it slowed down here. And now they're really focused on the components of the CPI, and we'll talk about the components in a few minutes. So we'll talk about the parts of it that are moving in the direction the Fed would like to see, and we'll talk about some other parts of it that aren't quite moving in the direction the Fed would like to see. Now, interestingly, if you look at the same picture across the world, not at every country, but at a few interesting countries, for example, other developed market economies like Australia, Germany, Japan, and the United Kingdom, the US is actually ahead of where they are. So this is the same set of inflation numbers plotted for those other countries. And you see that they have started going down a little bit, but not quite as much as our CPI has gone down in the US. So in some sense, the Fed is almost ahead of where other central banks are in this tightening cycle, and that has all sorts of ramifications for the US dollar and potential dollar weakness, but that's a story for another day. So the headline inflation number is actually looking okay in the US. So let's look at a little bit more about reading the tea leaves on the inflation front. So one of the big things that the Fed is concerned about is not only the level of inflation, which I just showed you, but also they're concerned about forward-looking measures of inflation. And one of the real key ones is, are consumers concerned that there will be inflation in the future? And why that matters so much is because if you are looking to buy something and you think it'll cost more in the future than it does today, maybe you're going to buy today rather than waiting, which causes more price pressures. And as an employee of a firm, you might say, look, I am pretty concerned that there will be inflation in the future. And when it comes time to do my wage negotiation with my employer, I might ask that employer to pay me more money because I anticipate my expenses will go up over the next year or the next 5 years. So the Fed is really concerned not only about the backward-looking measures of inflation, which is what the CPI tells us, but these forward-looking measures, which is what do consumers actually think? And for this, we have a very important survey from the University of Michigan. So they ask many questions. They conduct this monthly survey of consumer sentiment. And one of the questions they ask is, by about what percent do you expect prices to go up or down on average during the next 12 months? I think that may be a typo. And then they tabulate the answer to the survey, and you can see what's happened to that series. And this is also fairly comforting from the Fed's point of view, which is consumer inflation expectations also began to go up, and actually those started going up in 2022, so actually ahead of when inflation started to go up. And then started to go down in 2022. And now, the last data point ticked up a little bit. And I think certainly the Fed would like, and this is, another of that little piece of evidence that inflation is a little worse than the Fed thought at the end of January. And I think, generally the Fed and market participants would like to see this series continue to go down and inflation expectations on the part of consumers to continue to fall. I mean, I think that would be in the ideal world. So to sum up, so far, we have actual inflation falling, consumer expectation about inflation is falling, although it ticked up a slight bit in the last reading that they had. So the news here is pretty good. There's even more good news in the inflation front, which is two of the components of the inflation measure, which were very poorly behaved in 2022, are actually looking a little bit better now than they did last year. And what are these? Well, one of them is commodity prices. So the graph you see here is the S&P Goldman Sachs Commodity Index. It's a basket that includes about 60% energy, something like 30% agriculture, and 10% metals. And it spiked up a lot in early 2022, and largely on the back of the tragic conflict in Ukraine. But as the year sort of continued, it looked like a lot of the fears about the energy crunch in Europe and the energy recession in Europe and other bottlenecks like agricultural prices, like a lot of these things actually abated and surprisingly turned out a little bit better than people thought. So that contributed to early inflation in 2022 has become better on the commodity side. The other thing that happened during the COVID crisis was the supply chain was disrupted. You all read the stories. Basically, the truckers found other jobs. You had ships queuing up in the West Coast ports, and you didn't have the trucks to transport those goods, to unload the ships and then transport those goods into the country. And the same thing was happening on the East Coast. And this is why initially people thought that the inflationary spike would be transitory, because they thought a lot of it was just this COVID-induced supply chain bottlenecks that would work themselves out. And actually they have been working themselves out. And where we are now is, if you look at, for example, retail inventory measures, so how many goods are sitting on the shelves of retailers in the US, the year-over-year growth in that number is actually really big. So the data point here is saying that there shouldn't be goods price inflation either, because our retail chain is just awash in consumer goods at this point, and there's other measures of this, like shipping costs. All of these kind of bottlenecked aspects that happened after COVID have been sort of fixing themselves over time, and those have been relieving some of the inflationary pressures coming from commodities and goods prices. So that's all good news. So where's the bad news? Well, if all of this stuff looks so good, what's the problem here? Well, the problem is that we have a tight labor market. And the problem with the tight labor market is that there are basically more people looking to hire workers than there are workers looking for jobs. Of course, it's not in and of itself bad that there's a lot of jobs. Of course, that's great. And yesterday there was the exchange between Elizabeth Warren and Jay Powell about, well, why do you want to choke off job creation to control inflation? And he said, well, no one will be helped if we have 5 to 6% inflation in the country. We can argue for hours on end about the policy aspect of this, but from an inflationary point of view, here's the mechanism. You have a tight labor market and you have consumers who expect inflation to be high in the future. And what that results in is higher wages, because people say, look, you need to hire me. I'm afraid of higher inflation. Pay me more if you want to hire me, and employers do. And that leads to higher wages, and that leads to stronger consumer demand. As that happens, you have two things that are consequences. One is employers now have a higher cost of running their business because they have to pay higher wages to their employees. And at the same time, there's more demand on the part of consumers who are receiving higher wages for goods and commodities, which then drives up goods and commodity prices, which in turn increases the expenses faced by households. and then the cycle just begins to feed on itself. It becomes this sort of self-fulfilling prophecy of, sort of the Phillips curve idea, like higher wages, higher demand, higher costs, higher goods prices, higher inflation, higher inflationary expectations, higher wages, and the whole thing just runs in a circle. And this mechanism, I think, is where the concerns are now focused, is how do you break this sort of wage price inflationary spiral? And the way you can see how this is manifesting itself is to look at the part of inflation that's due to services. Of course, our service economy is very large in the US. And if you look at the measures of the cost of services, that is sort of the one component of inflation that has not been ticking back down. And that is exactly because of this tight labor market inflationary spiral. And this is exactly what the Fed is concerned about. And this is why it's trying to tighten policy, sort of get prices in financial markets under control, and lead to a mild, hopefully, slowdown in economic growth to sort of break this wage price spiral. Okay, so to sum up, we've had some good news in the inflation front: goods prices, commodity prices. However, services inflation and wages in a tight labor market are contributing to inflationary concerns. And now you have an aggressive Federal Reserve stepping into the picture, and likely what they will do is going to work, and they will slow down economic growth enough, and you will have a slowdown in inflation. The risk here is that, given how much market attention there is on this inflationary dynamic, and given how much media attention there is, the Fed is not impervious to all the stuff that they're hearing from market participants in the media. And they're really in a position where they now feel they need to act. And when the Fed feels they need to act, look, they're very good at what they do, but there is now, it seems, a risk that they will over-tighten, that they are so incentivized to control inflation that they actually introduce more monetary policy tightening into the system that they need, and that causes a larger slowdown than they had anticipated, or that they even want. And I don't think that's the base case, but that is certainly one of the risks. One of the risks that's out there. So how does this all translate to, portfolio decisions, valuations, and portfolio allocation? So let's talk about that next. So on the valuation side, one of the key things that we do at QuantStreet is think about a projection of future returns across the asset classes into which we invest. And so one of the key variables in our decision-making process is really the set of forecasts that come from our asset valuation models. These forecasts feed into our portfolio optimizer, which then answers the question of, given an individual's risk preferences and liquidity preferences, how do we construct for that individual the portfolio that has the highest possible expected return given our asset class projections? Now, we've spent a lot of time thinking about how do you explain the output of these models in a way that people understand. Let me show you early attempts at this challenge looked like this. You had tables with an enormous number of numbers and all these abbreviations, and generally showing these sort of outputs to people didn't get them overly excited. So we kind of, we look at these a lot, but when we went back to the drawing board, we thought to ourselves, how can we create something that is more, understandable to people who don't spend all day and night thinking about these kinds of issues. So let me show you what we came up with, and hopefully this will convey to you some of the dynamics in the market and how they manifest themselves in portfolio decisions. So here is what we call our S&P 500 waterfall. So this is our model that is creating the year ahead forecast for returns on the S&P 500 index. Let me explain to you the components here. The blue bar, which is called base, is telling you our model's forecast for the returns of this aggregate US stock market measure over the next year, if every single forecasting variable, and there's a bunch of different forecasting variables, Jake mentioned machine learning, analytics, a lot of it is going into generating this model output. But if every forecasting variable was at its average value, that means nothing is too hot, nothing is too cold. Our model return forecast for the S&P would be plus 12%. So we would be forecasting the market should go up by 12% over the next year. What each of the little green and red bars is showing you is how we're modifying that 12% forecast, because some of the variables that go into our forecasting model are now at a level different than their average value. And so let me not talk about all of these. So there's a bunch of minor adjustments you make by looking at things like economic policy uncertainty and market volatility and earnings growth. But here's the big adjustment. The big adjustment comes from this mysteriously named variable SPX EPRF. And the level of this variable, and I'll explain to you in a second what it is, because it's a very intuitive variable. The level of this variable is so different from its mean, it's low relative to its mean, that decreases our return forecast on the stock market from 11% to only 1.7%. So our model right now actually thinks that stocks in the US are particularly unattractive relative to how they usually look based on the model. So what's the problem here? The variable that's giving us pause is this thing called the earnings yield minus the 10-year rate. So what is this? The earnings yield is if I pay $100 for the S&P index, okay, how much do I get in annual earnings in my index for paying the $100? And right now, that answer to that question is you're getting about, depends on how you measure, but you're getting about a 3% or so earnings yield for every $100 that you invest in buying the S&P 500. So you spend $100, you buy a basket of companies. Those companies currently earn $3 a year. So you're effectively getting a $3 earnings yield per year by buying stocks. Now, what yield are you getting by buying bonds? Well, if you just buy 10-year treasuries, the yield on 10-year treasuries right now happens to be 4%. And one of the important forecasting variables in our model has been the difference between the earnings yield on stocks relative to the yield that you get by just buying bonds. And unfortunately for stocks right now, this measure, this earnings yield minus interest rate measure is here. It's the green line. It's actually gone down, 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 down for the last 2 years, even though stocks have sold off. It went down so much, not because stock prices went up, it went down so much because interest rates went up a lot. And so when I introduced our discussion initially by saying there is no alternative, well, the alternative now is bonds, and bond rates, the rate of return you would earn by buying a 10-year treasury and holding it to maturity is now quite high relative to the earnings yield of the stock market, which makes stocks, at least at this point in time, based on our model, look, relatively speaking, unattractive given their long-term history. So if you look at that 1.7% number, that's actually a fairly unattractive number in all the forecasts our model has made historically. So just looking at that for a second, this chart shows our model's expected return forecast for the stock market over time. This giant peak over here was when the market sold off around COVID. Our model thought the market was really attractive back then. It thought it was, pretty attractive here, but it's sort of gone down, down, down. And right now we're here, which is really at the low end of the historical return forecast that our model makes for the stock market. So, and why we're there is exactly because interest rates have gone up so much. So that's our visualization for the model's current forecast for stocks. Now let's do the same picture for bonds. And the bonds that we're going to look at here are investment grade bonds. So what are investment grade bonds? Investment grade bonds are very high quality bonds issued by American corporations, that we're going to be looking at US investment grade bonds. Think here like Verizon, Boeing, Bank of America, JP Morgan, and they behave a lot like treasury bonds, but they give you a slightly higher yield. And so we're looking at our model forecast for the return on investment grade bonds in the US. The blue bar, as before for stocks, is showing you that if every forecasting variable was equal to its average value in the window when we trained our model, the return forecast for investment grade bonds would be 1.4% for the coming year. And each of the subsequent green and red bars is showing you the adjustment that we would make to that base forecast, because variables are not at their long run average values, because variables are at different levels. And so the two big adjustments that are happening is, one, we adjust up our forecasted return for investment grade bonds to 2.3% because of the level of 10-year interest rates is now above its typical value. And we massively adjust up the expected return on bonds in our model to 12.8%, based on the fact that 2-year interest rates are now very high relative to their level where we were estimating when we were training our model. So just to give you a sense of how high those are, if you look at that picture, so the blue line here are 2-year rates. And when I did this picture, they were at 4.9%, actually higher now. And the white line is 10-year rates. So you see here the increase in interest rates we've seen over the last year and a half, still in the historical context, going back to like the inflationary shocks of the 70s and early 80s. This is nothing, but certainly compared to where we were in the decade after the global financial crisis, interest rates are now very, very high relative to that time period. And so our model really likes bonds and doesn't like stocks all that much, but really likes investment grade bonds and really likes treasuries and really likes international bonds. All things bond, our models currently like a lot. And if you look at the return forecast that our model makes for investment grade bonds, that's this orange line here, you see that actually this forecast that we're making for investment grade bonds is very, very high relative to the historical forecast the model has ever made. And the last point that was equally high for investment grade bonds was when investment grade bonds sold off a lot in like February, March of 2020, right as the COVID crisis was sort of hitting markets. They became very attractive then, and they're very attractive now as well. So our model is really kind of in sync with that Wall Street Journal article that stocks, because interest rates have gone up so much, are beginning to look a little bit less attractive, and bonds, because interest rates have gone up so much, and by buying bonds, you earn those higher interest rates, are now looking relatively more attractive than they did a year or a year and a half ago relative to stocks. That's the narrative that the Wall Street Journal article was trying to convey. And that's exactly what all of our models are saying at the moment, is exactly consistent with that narrative. So that's how our sort of machine learning data inspired view actually syncs up with what is the current, I think, narrative out there in the financial media. So what does it mean for our portfolio? Well, we feed into our portfolio optimizer all of these asset class return forecasts for stocks and bonds and commodities and international stocks and real estate investment trusts, and we feed it all in. And the model gives us back an optimal portfolio. And what happens is, as stocks begin to look less attractive and bonds begin to look more attractive, the model is going to take some of its allocation out of stocks and move it into bonds. And that's exactly what the model has done. And so I'm going to show you what our model looks like now. But before I show you what our portfolio looks like, let me just walk you through the chain of events that I think would need to happen for our portfolio to actually outperform a more stock-heavy portfolio. So here's what would need to happen. Media and market and political focus on inflation have to cause the Fed to over-tighten, to basically tighten a little bit more than would be optimal. And I think there's a real risk of that happening. That'll lead to higher short-term interest rates. It'll slow economic growth through a channel we already discussed. that slower economic growth will either lead to lower corporate earnings or a slowdown in corporate earnings growth, which potentially might imply lower stock prices, or at least it would imply not massively higher stock prices. Doesn't mean you have a big sell-off, but maybe stocks don't go up as much as they would otherwise. At the same time, you're going to have lower inflation, slower growth, and lower long-term interest rates, which of course is the panacea for bonds, and you'll have higher bond prices. So this is kind of the chain of events that would need to materialize for this more bond-heavy portfolio to do better than a more stock-heavy portfolio. So let me show you what our portfolio actually looks like. So at QuantStreet, we run different investments for different risk levels. So what I'm showing you here is what we call our core portfolio. And the blue bars are showing you our core portfolio's allocation as of the beginning of February, and the red bars are showing you the current allocation of the core portfolio as of the beginning of March. And let me just highlight some of the things. So we have an exposure to real estate investment trusts, which went slightly down from the beginning of February to the beginning of March. We have a large allocation to US stocks because I think at the end of the day, US stocks, by several measures I didn't show you, still look relatively attractive. But our allocation to the US stock market fell by about 10% month over month. So we are currently at the red line. Our allocation to value stocks, again, story for another day, why we like value stocks, didn't change. We had no position in investment grade bonds at the beginning of February, and we now have close to 10% of the portfolio invested in investment grade bonds. This is our commodity exposure. It fell by about 1% month over month. We also have a small exposure, for reasons that we can discuss offline, to non-US stocks. That went down a little bit. And this is our exposure to high quality government bonds that are not in the US. Why we want to have international exposure is because, what I mentioned earlier, the Fed is ahead in its monetary policy cycle relative to other global central banks. When that happens, ultimately the Fed will ease probably sooner than those other banks. That'll be bad for the dollar, which means US investors would be well off holding international assets as foreign currencies appreciate versus the dollar, which is why our portfolio has a little bit of an allocation to non-US stocks and non-US government bonds. And we also like non-US government bonds for the same reason right now that we like investment grade corporate bonds in the US. So the portfolio that we have now still has a large stock exposure. It's just about 10% less than the exposure that we had at the beginning of February. And it really is just reflecting the set of the set of events that we were discussing in this presentation. Okay, and the final thing I want to just point out is that there are risks to any investment thesis, and I just want to mention some of the risks that I perceive, and also I want to give you a caveat as a takeaway. So the risks are that earnings growth will reaccelerate despite Fed tightening. It is a real risk. There's amazing things going on in artificial intelligence, generative AI, these large language models. I think this stuff will cause an absolute revolution in productivity in the economy. I don't think that's going to happen next month, but that is certainly a massive upside catalyst for stocks. So that might materialize sooner than we think. That'll be good for stocks. When the Wall Street Journal is writing about it, it means that this is a discovered idea. So it feels a little bit like the overweight bond, underweight stock is a little bit of a crowded trade. Like, I think a lot of people are positioned that way. Like, our model likes it, independently of the Wall Street Journal article. It makes sense to me, but certainly, we're not the only people who have thought of this at the moment. So that's a risk. In my experience with markets, there's just a general disclaimer. Markets have a way of adjusting in ways that make portfolio managers look foolish. That's a cosmic law, nothing you can do about that. And the last thing I want to just point out is that, yes, we are now more heavily allocated to bonds, But that can change, over the course of a few weeks, basically. I mean, we're always rerunning the models. Interest rates are going up and down all the time. Stock prices are adjusting. So, if you talk to me in a month from today, if you attend our quarterly call next quarter, our allocation may look, different than this one. So none of this is written in stone. I mean, you should always know that whenever anyone is talking about their financial markets, what they like, what they don't like, I mean, that's kind of a point in time analysis. And these things can change really, really quickly and often do change really, really quickly. So I guess the advice is, be data dependent like the Fed says they are, and just, pay attention to all of these things as we do. Read our research, which I'll mention in a second, and keep on top of these things. So, okay, so to summarize a little bit of a commercial pitch. So, we give, I think, the little guys access to an intelligently designed data-driven portfolio allocation process. Our portfolios are customized to what clients would like to see in terms of risk and liquidity preferences. And with those constraints, respecting what the clients want, we sort of listen to the models and design a portfolio that takes into account all of these different dynamics that our models are capturing all the time. Check out our website. A lot of the commentary we'll write about it on our website, and you can just read all the different blurbs that we put out. As Jake mentioned, for RIAs, we'd love nothing more than to save you time to let you focus more on your clients. And if you would like to know more about our performance, which has been good, or our risk data, just reach out to us, to me or Isaac. We're happy to talk to you. So that's all I have, and I know that we have maybe a question or two, so why don't we open up to that?
Great. And by the way, if others have questions, please just put them in the Q&A box, and I will read them. I also just put a link in the chat to our website research and analysis section, so you can see detailed views of the markets there. So let me read our first question, and I think when Jake joins, he will read some as well. Assuming earnings over time should grow with inflation, would the current yield on inflation indexed bonds be a better basis to measure valuations than the yield on nominal treasuries?
So that's a really good question. It is actually one of our forecasting variables. So one of the variables that we track is something called the break even. And what the break even is the difference. Actually, I have a plot of it. Well, let me show you. It is here. So what the break even is, it's exactly the difference between the yield of nominal bonds and the yield of inflation protected bonds. And looking at the difference in those yields is giving you basically two pieces of information. One piece of information is what is the market's inflation expectation over the next, whatever, depends on the maturity of the break-evens you're looking at, and how much risk premium is there embedded in nominal bonds relative to inflation protected bonds. So we do look at it. To answer the question in a very direct way, we don't have a measure analogous to earnings yield minus the risk, the inflation protected yield, even though we have the inflation protected yield independently as a forecasting variable. So it's something we can look at. I think we do capture that information, but it's not something we have directly in the model. So it's a good idea. I like the idea, so we'll take a look at it, and that might make sense as well. So I think that's a good idea. I'm writing it down.
Okay, here. Just one moment. So let's see. I see one hand raised. So Arthur, if you want to put your question in the chat, I will be glad to read it.
I do see a question from Jorge, so let me just read it. It says, does robotics and AI make people sort of reallocate in their jobs? So that's a good question. So I think yes. I mean, I think how we do our work will change as robotics and AI become more pervasive. But that's always been the case, Bob Schiller has a wonderful book called Narrative Economics, in which he discusses a lot of the common narratives that have existed in financial markets over the course of hundreds of years. And one of the narratives that he singles out is the idea that technology will destroy jobs and basically put people out of work and people won't have anything to do. And that fear existed really right at the beginning of the Industrial Revolution. And so it hasn't materialized in the way that, in the dire sort of way, in the sense of like people sit around without jobs, but certainly jobs change. And what people will be doing is going to change. So, look, a lot of these tools like ChatGPT are being used by people who are not technical people. They're being used by people who are lawyers and by people who are journalists and by people who are historians as a way of helping them become more productive. There's talk about Microsoft embedding some of those large language models directly into Microsoft Office, which means like you can be working on your Excel spreadsheet and you can sort of tell Excel, well, can you plot the data for me just in English in this way or that way? And it's just going to do it. So it means that some of the hours and hours that people spend on polishing up and tinkering with their charts, are going to not be needed, but people will just become more productive and do new things with their time. And so I think jobs will shift and we'll find other more productive ways of doing what we do and do things we haven't even thought about doing. Could it bring more inflationary pressure is the follow-up question. I think generally technology is disinflationary, not inflationary. I mean, I think as we become more productive, as the real output per hour worked increases, I mean, I think all of that is working to make goods less expensive, not more expensive. So generally, I would think, technology, data, the ability to monitor inventories in real time, efficiency increases, all of these things I think are ultimately deflationary, not because people will make less money. People will earn more in real terms, and that, thank God, because we've been earning more in real terms, and we now all live way, way above subsistence, which is where humanity was 500 years ago. So people will earn more money, but they'll be so much more productive that actually there'll be more stuff being produced. And the net effect of it is people will be able to afford more stuff with their earnings rather than less stuff. I mean, I think that's where technology is going to ultimately bring us.
Yeah, Harry, if I could add to that, because I had a question too, but you look at not just the technology automation, but robotics and automation in things like restaurants, right? So if you anecdotally drive around any town, there's 4 help signs at every Arby's and Taco Bell and for $16 an hour, right? And that's fairly high, but it's not, that's not going to make somebody rich, obviously, right? But at a certain point, that triggers the, whether it be manufacturing or food service, them to automate, right? So then those $16 to $20 an hour jobs won't be there, which could be a good thing. Then those people could go get a trade job that pays even more, but then your burger still costs $7 instead of 15. So I just wanted to add to that because we have a friend that's a portfolio manager in the robotics and automation space. So has been coming for 10 years, and it probably is finally getting to the point where it's cost effective for businesses. And then those employees can get better paying jobs or get better trained to get higher paying jobs. But I did have a question for you, Harry, going back to your change in allocation, where you essentially allocated to 10% more to bonds and 10% less to stocks, or at least have about 10% less in stocks, and maybe scattered through some of the other opportunities. What kind of triggers, because you mentioned you look at this all the time and it could change on a weekly basis, essentially, not that you're going to get whipsawed, but can you explain a little bit more that data in, action out, as to, it might be simple for me to say, okay, if there's a correction, obviously, and stocks are 20% less, valuations look better, but you go back into stocks. That's me oversimplifying it. But can you explain a trigger that would cause you to go the other way, or maybe even less? Maybe, maybe the Fed does keep acting and we're 1% higher in the Fed rate in 2 months, and we're seeing another notch down in stock. So just looking for more of an explanation on what triggers the change in reallocation, and maybe how often you do that. And maybe it's not time dependent, it's data dependent.
Right. So I think it's exactly right. It's data dependent in the sense of, prices are updated every day. We watch them every day. When things, typically day to day, like what happens on Tuesday gets partially reversed on Wednesday, and things sort of don't really change that much. But like after a week that things have actually moved a lot in one direction, we just rerun the model. So we say, okay, let's rerun all the asset class forecasts, let's rerun the optimal portfolio allocation, and let's see what it looks like. Now I traded in the industry for many, many years. I mean, as a portfolio manager, you have a huge desire to just trade because you feel like you're doing something. But if you actually read, there was just in the Wall Street Journal. So Jason Zweig wrote an article quoting Warren Buffett that basically said, like, the best decisions I've made often is just to do nothing. And, so we reassess, we redo the models, we redo the portfolio allocation. And when things have moved enough, we'll trade, so I don't think we want to trade every day and say like, oh yeah, like, we're 50% stocks, let's move to 51%, like that sort of thing. We'll just leave it alone. At the point where like our allocation is about 5 to 10% off from where we'd like it to be, then we're going to retrade. So typically that happens about once a month. Actually, one time so this is earlier last year when things were really moving a lot, we actually did an intra-month rebalance, like within the month, because things had just moved so much. So it's to answer your question, it's not time dependent, it's more like data dependent. So we reestimate the model, we redo the asset allocation. When we've moved enough, a few percentage points away from where we are, then we'll do the reallocation. That's typically how we work.
Thank you.
All right, so I see 2 more questions, and I think we want to be, cognizant of people's times and hold this to under an hour. So we have 3 more minutes. So what are some good roles for fintech which you could suggest to computer engineers? So look, I would say every major bank, every major asset manager has computer engineering jobs because so much of finance is now so data intensive and process intensive. In addition to that, you have an entire ecosystem of data providers of firms who don't manage money, but who provide data and analytics. For example, Bloomberg, S&P, Moody's, Fitch, Refinitiv, MSCI, the list sort of goes on and on. So there's a whole ecosystem of firms that look a lot like just software houses that write software into data analytics and then sell that as a service to either sell side or buy side clients in the street. So, just go on their websites, go type into Google 100 largest asset managers. Okay, you're going to see like BlackRock, Fidelity, Invesco, on and on and on. They all hire computer engineers. Goldman, Morgan Stanley, JP, all of them hire computer engineers. Just go to the websites, they have postings. And, if you're interested in making that switch, apply. All right, so that would be like 30 seconds of career advice on that front. I see a question. The analysis focuses the S&P 500. How do you think about US small caps, large international? Okay, so great question. How do we think about other stock market indices? So our S&P forecast, so that was from Olivier. Thanks, Olivier. It's a good question. Our S&P forecast, like this thing here, is generated from one model that has one set of inputs. We have a different model with a different self-selected set of inputs for every asset class that we trade, including VXUS, actually we don't have a small cap index, but including things like financials, technology, emerging market, developed market, non-US, real estate investment trust. So like for every collection, either industry or geographically focused or style focused, like value and momentum, for each of those, we run our model. It chooses a different set of forecasting variables. The model is estimated usually over a different training window. So the models are customized for the index that we are investing in. Each index has its own model. Each model finds a different set of forecasting variables, and each model finds a different set of loadings on the forecasting variables that it actually is using. So the models self-differentiate per asset class. So we would exactly know the right set of forecasting variables, at least in our training for VXUS, and they would be different for what we're using in S&P. But that's a really good question. Okay, so I think, so we're an hour into it. I don't think we should take up more of people's times. So thank you very much for listening to us. And please reach out. We'd love to talk to you about big or small things. Any questions you have, reach out to Jake or Isaac or me. And we'd love to hear from you. So thank you for listening.
Thanks, Harry. Thanks, Isaac. And just referencing back to the link that Isaac sent about the research, or just go to QuantStreet Capital, right? QuantStreetCapital.com. For those listening now or on the recording, and there's plenty of insights there, and they'll keep coming. So thanks, everyone.
Thank you. Thank you. Bye-bye.